Welcome back to the deep dive.
Always good to be here.
So today we're digging into a company that, well, you might not know the name instantly,
hmm
but their technology, it's absolutely everywhere. It's fundamental.
Yeah, it really is. We're talking about Lam Research Corporation, ticker LRCX.
LRCX.
Right.
And they're not the ones, designing the latest processor for your phone or computer memory.
No, that's not their game. They're the ones who build the incredibly complex machines, the highly sophisticated mission-critical equipment.
The actual tools that companies like Intel or Samsung or TSMC use to make those chips.
Exactly. They're like a critical enabler, maybe the silent partner behind the whole digital economy.
So that's our focus for this deep dive.
hmm
We really want to unpack why Lam is so important.
Understand its, unique position in that whole semiconductor world.
Look at its strengths, which are considerable,
Oh, definitely.
but also face the risks head on because, well, there are some pretty significant ones here.
There really are. And just so you know, we're basing this discussion on a pretty detailed investment analysis we've gone through.
Right, so it's thorough, data-driven.
Yeah, aiming for a solid exploration.
Okay, so what's the mission then? What should you, our listener, take away from this?
Well, the goal is for you to get a really comprehensive picture of Lam research. We want you to understand, how vital it is for technology globally, but also grasp the really complex mix of technology, economics, and maybe most critically, geopolitics that shapes this company.
It's a lot to juggle.
It is. So we'll distill the key insights from the analysis, help you see why Lam is such a linchpin in the tech supply chain. Hopefully you'll feel well-informed without getting totally bogged down in the details.
Sounds good.
Because, as the analysis puts it, Lam really sits at this fascinating intersection of powerful secular growth trends and significant cyclical and geopolitical risks.
A real balancing act.
Exactly. Should be an interesting discussion.
Okay, let's get into it then. What does Lam Research actually do? Founded back in 1980, so they've been around a while.
A long time in tech years.
And like we said, they're not designing the chips. They're engineering and building that highly sophisticated mission-critical equipment. The machines that turn chip designs into actual silicon reality.
Yeah, and the analysis really drives home how important that is. It says nearly every advanced chip is built with Lam technology.
Wow, nearly every advanced chip. That's huge.
That makes them completely indispensable, really, to all the big semiconductor players.
So for you listening, just pause and think. That phone in your hand, the servers running the cloud, your laptop.
Even your car, increasingly.
Right. They all rely on these super complex manufacturing steps that Lam's machines made possible.
You almost can't overstate it. Without companies like Lam, our digital world just wouldn't look the same. It's that foundational.
Okay, so how do they actually make money from this? How does the business work?
Good question. To really get Lam, you need to understand their two main revenue streams. And they work together in an interesting way, balancing growth and a bit of stability. First, there's what they call systems revenue.
Okay.
This is basically selling the brand new machines, the cutting-edge wafer fabrication equipment, or WFE.
The big ticket items.
Exactly. The analysis uses this analogy. Think of it as the razor.
The initial sale.
Right. Now, this part of the business is, by its nature, very cyclical. It goes up and down pretty sharply.
Because it depends on when the chip makers decide to spend big money on new factories and equipment.
Precisely. It's tied directly to their capital expenditure, their CapEx cycles. And those cycles are influenced by everything: global demand for electronics, chip prices, new technology waves.
Right.
And we see that in the numbers. The analysis shows systems revenue dropped from over $11.3 billion in fiscal 22 down to about $8.9 billion in fiscal 24.
So a noticeable dip.
Yeah, and that directly reflected a wider industry downturn, especially in memory chips, which is a big market for Lam.
So the razor sale establishes the relationship.
Exactly. It's that initial high-value sale. And that leads perfectly into their second revenue stream.
Which, following the analogy, must be the blades.
You got it. The blades are the Customer Support Business Group, or CSBG.
Okay, so what does that involve? Keeping the machines running.
That's a big part of it. This is where Lam builds this really high-margin, long-lasting revenue stream. What's really key here is how stable and recurring this business is compared to the new equipment sales.
Right.
CSBG revenue comes from, well, all the things needed after the sale. essential spare parts, critical upgrades to keep the machines competitive, ongoing maintenance, repair services.
Makes sense. These machines must be incredibly
They
complex.
are. And Lam even sells refurbished older equipment, their Reliant systems, for less demanding applications.
Ah, interesting. So they capture value from older tech, too.
Definitely. And the engine driving all this CSPG revenue is Lam's massive installed base.
How big are we talking?
The analysis says over 90,000 Lam process chambers are installed globally now.
90,000.
Yeah.
Yeah.
Once you sell these complex systems, they need constant feeding support, parts, upgrades. It's a continuous need.
And you can see that growing importance in the numbers, too.
Absolutely. CSBG grew from about 34% of total revenue in fiscal 22 to over 40% in fiscal 24.
So it's becoming a bigger slice of the pie.
A much bigger slice. And that's really important because it provides a crucial ballast, as the analysis puts it, against the ups and downs of the new equipment market.
So it smooths things out a bit.
Exactly. And connecting this to the bigger picture for you, this shift isn't just a minor detail. It could fundamentally change how investors look at Lam. A bigger chunk of predictable recurring revenue often means less perceived risk, maybe less earnings volatility.
Which could support a higher valuation multiple down the line.
Potentially, yes. It suggests Lam might be evolving from a purely cyclical company into something a bit more resilient. It's a key part of their story.
Okay, that makes sense. Now let's get into the real magic, the technology. What makes Lam's equipment so special? You mentioned their mastery of the microscopic.
Right. Their leadership isn't just about building reliable machines. It's about pioneering and perfecting these incredibly intricate processes that happen at the atomic scale. Their dominance really comes from deep expertise in three critical areas of what's called front-end wafer processing.
Front end. So the early crucial steps in making the chip.
Exactly, before the wiring and packaging. And the first one is deposition.
Deposition. Laying stuff down.
Precisely. Imagine the silicon wafer is like a blank canvas. Deposition is the process of applying ultra-thin layers of different materials onto that wafer. Think of it maybe like building a tiny complex 3D structure layer by painstaking layer, sometimes just one atom thick at a time.
One atom thick. That's incredible precision.
It is, and Lam uses various advanced techniques here. There's atomic layer deposition, ALD, for that incredible atomic scale control. There's also chemical vapor deposition, CVD, which is a workhorse for many different materials, and electrochemical deposition, ECD, which is especially vital for creating the copper wires or interconnects on the chip.
Okay, so they have different tools for different deposition jobs. Specific product lines mentioned.
Yeah, the analysis mentions names like Altius, Vector, and Stryker as key product families in deposition.
Got it. So step one, carefully deposit layers of material. What's next?
Next comes etch. And this is an area where Lam is the undisputed global market leader.
Number one in etch. So if deposition is building up, etch must be taking away.
Exactly right. It's the crucial subtraction step. The analysis calls it a highly complex and critical process. After you've laid down your layers, you need to selectively remove material to create the actual patterns, the transistors, the tiny 3D features that make up the circuit.
Like sculpting, but on an impossibly small scale.
That's a great way to think about it, like atomic level sculpting. Instead of a chisel, they use things like plasma to precisely carve away material.
Plasma, like in a sci-fi movie.
Sort of. They use reactive ion etch, or RI, which uses plasma for high precision. And for even finer control, there's atomic layer etch, ALE, which can remove material literally one atomic layer at a time.
Mind-boggling stuff. And they have specific products here, too.
Keo for conductor etch, carving the metal pathways, and Flex for dielectric etch, shaping the insulating layers.
Okay, so deposit, then etch. What's the third critical process?
The third one might sound less glamorous, but it's absolutely vital. Keen strip.
Cleaning the wafers.
Meticulously cleaning them. This step is essential for achieving high manufacturing yields. Think about it. You're doing hundreds of these incredibly precise steps. If even a microscopic speck of dust or a chemical residue gets left behind.
It could ruin the whole chip.
Exactly. A single tiny defect can kill a multi-million transistor chip. So wafers have to be meticulously cleaned repeatedly throughout the process.
Makes sense. What kind of cleaning are we talking about?
Lam offers advanced solutions using wet chemicals and also plasma-based cleaning, especially for the edges of the wafer, the bevel. Product lines here include the SP series and EOS platforms.
So, deposition, etch, and clean. These are the core competencies.
That's the heart of it. And what this all means for you is that Lam's technology is quite literally shaping the physical reality of computing at the most fundamental level possible. They ensure chips aren't just designs on paper, but actual working microscopic marvels.
Truly indispensable.
Uh-huh.
Okay, so we know what they do. Let's talk about who they do it for and where.
Right. That naturally leads to the question, who are Lam's customers and where is their business concentrated geographically? First, the customer base. As you might expect in this industry, it's highly concentrated.
Meaning a few big players make up most of their sales.
Exactly. Our sources list the absolute giants of the semiconductor world. Foundries like TSMC, memory makers like Samsung, Micron, SK Hynix, and integrated guys like Intel.
So the household names in chip making.
Pretty much. But that concentration comes with risk. The analysis points out that in fiscal 24, just one customer was 17% of Lam's total revenue.
Wow, 17% from one company.
Yeah, and in fiscal 23, two customers combined were 22% and 16%. That's 38% from just two companies.
That's a huge dependency if one of them changes strategy or cuts spending.
It has a massive material impact on Lam's results. It's a constant balancing act for them, nurturing these deep partnerships while managing the risk that comes with relying so heavily on just a few key players.
Okay, customer concentration. What about the types of chips their equipment is used for? The end markets.
Good point. Let's look at the end market exposure. For fiscal year 2024, the breakdown was roughly 42% memory. That includes both 3D, NAND flash, and DRAM.
Okay, memory's the biggest chunk.
Right. Then 40% foundry companies like TSMC that manufacture chips designed by others.
Okay.
And the remaining 18% was logic and IDM integrated device manufacturers like Intel who design and make their own logic chips.
So a heavy tilt towards memory historically.
Definitely. Lam has always had a very strong position in the memory market, but that's also, as the analysis notes, the most cyclical part of the semiconductor industry.
So that exposure contributes to Lam's own revenue swings.
Precisely. Memory prices and demand can fluctuate wildly, and Lam's fortunes are closely tied to that segment's health. It explains some of the volatility compared to more diversified peers.
Okay, makes sense. Now the really interesting one, geography. Where's all of this business happening?
This is critical. Lam's geographic exposure is overwhelmingly international, and it's intensely, even extremely concentrated in Asia.
Asia dominates.
Massively. Let's look at the quarter ending June 2025. China alone was 35% of revenue.
35%.
Then Korea at 22%, Taiwan at 19%, Japan at 14%.
So add those up. That's 90% just from those four Asian countries.
Pretty much. The U.S., for comparison, was only 6%.
Wow. And you said China was even higher for the full year.
Yeah, for the full fiscal year 2024, China accounted for a staggering 42% of Lam's total revenue.
42% from China alone. That feels significant.
It's incredibly significant. And this isn't just a data point. It leads us directly into the major geopolitical risks facing the company, which we absolutely need to unpack later. But yeah, that extreme concentration in China is a huge vulnerability.
Okay. Definitely something to keep in mind. Let's shift gears a bit then. Let's talk about the industry itself. You mentioned Lam as a leader, but who else is playing in this sandbox? Our sources called it an oligopoly.
That's right. The wafer fabrication equipment, or WFE market, is highly consolidated, characterized by an oligopolistic structure. Fancy words, but it just means a few big companies dominate. Lam is one of the absolute leaders.
Why so few, though? Why isn't there more competition?
It boils down to what the analysis calls formidable barriers to entry. They're incredibly high.
Like what?
Well, first, extreme capital intensity. Think billions with a B in R&D just to develop one new generation of equipment.
Okay, that weeds out a lot of potential players right there.
Definitely. Second, you need deep technological expertise. We're talking decades of accumulated knowledge in physics, chemistry, materials science, precision engineering. It's incredibly specialized.
Not something you can just learn quickly.
Not at all. Third, high switching costs. Once a chip maker like Intel qualifies a Lam tool for a critical production step, a process that might take years to perfect, switching to a competitor's tool is incredibly expensive, time-consuming, and risks messing up their entire production line.
So they tend to stick with who they know works.
Very much so. It creates tremendous stickiness. And fourth, long-standing customer relationships. These equipment companies work hand in glove with chip makers, sometimes years ahead, co-developing the processes for chips that don't even exist yet.
Deep partnerships.
Extremely deep. So For you, the listener, what this means is competition isn't really about price wars. It's about who has the best technology, the most innovative solutions.
Which creates a pretty stable environment for the big players like Lam.
Exactly. It's a stable and profitable landscape for the incumbents, largely protected from disruptive new entrants.
Okay, so it's a stable structure, but you also said it's very cyclical.
Yes, that's the paradox. While the competitive landscape is stable, the demand within that landscape is inherently cyclical. WFE spending goes up and down with chipmaker budgets, electronics demand, the global economy.
Right, the booms and busts.
Exactly. But, and this is crucial, beneath those cycles, our sources point to these incredibly powerful secular growth drivers, long-term trends that are pushing the whole semiconductor industry relentlessly upwards. We're talking about a projected $1 trillion market for annual semiconductor sales by 2030.
$1 trillion. That's a massive number. What's driving that growth?
Several huge forces. First, artificial intelligence and high-performance computing, HPC. This requires an enormous build-out of advanced GPUs, CPUs, and crucially, high-bandwidth memory, or HBM, to keep them fed with data. Lam plays into all of that.
AI is definitely everywhere now.
It is. Then you have 5G and IoT, the Internet of Things. This creates broad demand for all sorts of chips in connected devices, sensors, infrastructure.
Okay.
And don't forget automotive electrification and autonomy. Cars are becoming data centers on wheels, needing tons of chips for batteries, safety systems, self-driving features, infotainment.
Right, cars are packed with tech now.
They really are. And industry forecasts reflect this underlying strength. WFE spending is expected to bounce back strongly in 2025, maybe hitting somewhere between $105 billion and $125 billion.
So cycles, yes, but the long-term tide is definitely rising.
That's the key takeaway. Powerful secular trends are lifting the entire boat.
Got it. And within this oligopoly, Lam's position is strong.
Extremely strong in its core areas. The analysis is clear. Lam holds the #1 market share in semiconductor etch and a very solid #2 market share in deposition.
Number one in etch is huge, given how critical you said that step is.
It is. That leadership, especially in etch, forms a major part of their economic moat, their sustainable competitive advantage. It's what protects their profits.
So who are the other big players they're constantly battling?
Well, the biggest fish in the WFE pond overall is Applied Materials, or AMAT. They're more diversified than Lam, competing across deposition, etch, implant, inspection. They are Lam's main rival in etch and deposition.
Okay, AMAT. Who else?
There's Tokyo Electron, or TL, a huge Japanese competitor. They're strong in deposition, etch, and also in coater developers used in lithography.
TKL got it.
Then you have KLA Corporation, KLAC. They absolutely dominate process control, the inspection and measurement tools that ensure chips are made correctly. They don't directly compete with Lam's core areas, but their tools are essential and complementary.
KLA for checking the work.
Right. And finally, the giant in lithography, ASML, they have a monopoly on the most advanced EUV lithography machines, which are critical, but again, they don't directly compete with Lam in etch or deposition.
So Lam isn't trying to do everything, but they dominate specific vital steps.
Exactly. That focus allows them to achieve world-class expertise and leadership in etch and depositions, which are becoming ever more critical. It's a key part of their competitive strength.
That makes sense. So how do they stay ahead? This technology changes so fast.
That's the multi-billion-dollar question. The answer, according to our sources, lies in Lam's ability to solve the industry's biggest challenges, these major technology inflections.
Inflections, like turning points in how chips are made.
Precisely. Fundamental shifts that require totally new manufacturing approaches. And what's key is that these shifts are actually increasing the demand for Lam's core etch and deposition technologies.
How so? Give me an example.
Okay, think about 3D architectures, like 3D NAND memory, where you stack memory cells vertically, or FinFET transistors in logic chips, which also have a 3D structure. Moving from flat 2D designs to these vertical structures structurally increases the intensity of etch and deposition steps.
Meaning you have to do more etching and depositing for each wafer.
Exactly. You're building taller structures, layer by intricate layer. More layers mean more deposition steps, more complex etching steps to shape those layers. So as companies add more layers to NAND or refine FinFETs, it directly expands Lam's addressable market per wafer. They get paid for more steps on the same piece of silicon.
More touches, more value. Okay, what's beyond current 3D tech?
The next big leap is gate-all-around, or GAA, transistors. This is the successor to FinFET, coming in at the 2-nanometer node and below.
GAA. What's different?
In GAA, the gate material, the part that switches the transistor on and off, completely surrounds the channel where the current flows. This gives better control, better performance.
But I bet it's harder to make.
You bet. The analysis says it requires even more complex manufacturing processes, more steps, finer precision needed in both deposition and, crucially, etch. The good news for Lam is they've anticipated this. Our sources say they've already launched new tools specifically designed for GAA manufacturing.
So they're positioned for that transition.
They seem well positioned to capture a significant share of this new market opportunity.
Okay, 3D GAA. What else? You mentioned packaging earlier.
Yes, advanced packaging. This is huge, especially driven by AI. Technologies like high bandwidth memory, HBM, and chiplets, instead of one giant chip, you're connecting multiple smaller chips or stacking memory dies vertically within a single package.
Like building with Lego bricks instead of carving from one big block.
Kind of, yeah. And HBM, which is vital for AI accelerators, involves stacking DRAM chips and connecting them using through-silicon vias, or TSVs.
TSVs. Sounds complex.
They are. They're tiny conductive channels etched right through the silicon die. Making these requires incredibly precise, deep silicon etching and filling them with copper. And Lam is a leader here with their Syndion deep silicon etch systems and Sabre 3D electrochemical deposition tools for the copper fill.
So Lam's tools are critical for enabling HBM and chiplets.
Absolutely critical. So connecting this back for you,
Yeah.
all these big technology shifts, 3D, GAA, advanced packaging, they all structurally favor Lam's core competencies. They make etch and deposition more complex, more critical, deepening the reliance on Lam's specialized tools.
So the technology roadmap itself widens Lam's moat.
That's what the analysis suggests. It widens Lam's competitive moat over time. And the AI boom, it's like a dual catalyst. It drives demand for the most advanced GAA logic and the HBM that needs advanced packaging.
So Lam benefits on both fronts.
Yeah, making them a potentially comprehensive and resilient beneficiary of the AI hardware build-out. They're right in the sweet spot of multiple major trends.
Okay, that's a compelling technology story. Let's see if the financials back it up. How has Lam actually performed?
Well, the financial picture really shows a company that's successfully capitalized on the growth of the semiconductor industry, like we talked about, while also managing those inherent cycles.
So let's talk revenue first. Growth.
Definitely growth over the longer term. Revenue climbed pretty impressively from around $10 billion in fiscal 2020 to a peak of $17.4 billion in fiscal 23.
Quite a jump. But then you mentioned the downturn.
Right. Reflecting that industry slowdown, especially in memory, revenue moderated to $14.9 billion in fiscal 24.
Still a big number, but off the peak.
Exactly. But here's the interesting part showing the rebound. The most recent quarter, the one ending June 2025, saw revenue surge 33.6% compared to the year before, hitting $5.17 billion.
Okay, so a strong bounce back is underway.
It certainly looks that way. It highlights the cyclicality, yes, but also the strong underlying demand and Lam's ability to capture it when the market turns.
And what about profitability? Can they maintain margins through those ups and downs?
That's one of the most impressive parts of the story. Their margin expansion and resilience. Despite the revenue swings, Lam has kept its non-GAAP gross margins consistently in the mid to high 40% range.
Pretty healthy.
Very healthy. And they actually hit a multi-year high of 50.3% gross margin in that recent June 2025 quarter.
Over 50% gross margin.
Wow.
And operating margin.
Also very strong. They hit 34.4% non-GAAP operating margin in the same quarter.
So what does that tell you? Why are their margins so strong and seemingly getting stronger?
The analysis suggests it's because the increasing technical complexity of new chip generations commands higher pricing and carries structurally higher margins for Lam's enabling equipment.
Ah, so as chips get harder to make, Lam solutions become more valuable and they can charge more.
Essentially, yes. Their indispensability increases with complexity, allowing them to maintain that elite profitability. They're selling value, not just machines.
It's elite profitability. Let's dig into that. How does it stack up using standard metrics?
This is where Lam really shines. Our sources talk about elite levels of profitability. Look at return on equity, ROE. It's consistently been above 40%, even hitting 52.7% for the 12 months ending March 2025.
Over 50% ROE. That's phenomenal.
It really is. And return on invested capital, ROIC, a measure of how well they use all capital, debt, and equity, has frequently exceeded 30%. It was 35.5% for the same period.
So top-tier returns.
Absolutely. These numbers put Lam in the upper echelon of industrial and technology companies. It clearly shows they generate substantial profits from a relatively modest capital base.
Which points back to that strong competitive position.
Exactly. The analysis calls it a hallmark of a business protected by strong intangible assets and high barriers to entry. Their moat allows them to earn these outsized returns.
And does that profitability translate into strong cash flow?
Oh, absolutely. The analysis literally calls Lam a prolific cash flow machine.
Prolific?
Yeah, they generate billions in cash year after year. Even in fiscal 24, during that revenue dip, they pulled in $4.7 billion in operating cash flow.
Wow. And free cash flow after investments.
Still a massive $4.26 billion in free cash flow for FY24.
So they're just throwing off cash. What does that allow them to do?
It gives them enormous financial flexibility. It funds that huge critical R&D budget we talked about.
Right, keeping the innovation engine running.
Mm-hmm. And it allows them to execute a really substantial capital return program for shareholders through dividends and buybacks. It's the fuel for everything.
And is the balance sheet strong enough to support this, especially through the down cycles?
Yes, that's another key point. Their balance sheet strength. It's described as strong and flexible. As of March 2025, their current ratio was 2.45, meaning plenty of short-term assets to cover liabilities.
Healthy liquidity.
Very. And their leverage is quite moderate. The debt-to-equity ratio was down around 0.47. They're not overly burdened by debt.
So they're financially prudent.
Seems so. This prudence is vital in a cyclical industry. It means they can weather downturns comfortably, keep investing, and maybe even make strategic moves when others are struggling. They're built to last.
Okay, strong profits, massive cash flow, solid balance sheet. How do they return that value to shareholders? You mentioned capital returns.
Right. Management seems to have a very disciplined and shareholder-friendly approach here. Let's start with the dividend policy. Lam started paying a dividend in 2014 and has increased it for 10 consecutive years.
10 straight years of dividend hikes. That's a strong signal.
It signals commitment and confidence in future cash flows. And the payout ratio, the percentage of earnings paid out as dividends, is quite conservative, around 25% of earnings.
Meaning it's well covered and has room to grow further.
Exactly. Plenty of headroom for future increases. The latest dividend mentioned was $0.23 per share declared in May 2025.
Okay, dividends are one piece. What about share buybacks?
That's the other major pillar. Their share repurchase programs are described as aggressive and opportunistic.
Aggressive, meaning they buy back a lot of stock.
Yeah, it's a key way they return cash. By buying back shares, they reduce the total number of shares outstanding.
Which boosts earnings per share for the remaining shareholders.
Precisely. Even if total profit stays the same, profit per share goes up. It's a direct way to enhance shareholder value. For instance, they had a $5 billion buyback program authorized in May 2022, and they executed $3.42 billion in repurchases just in fiscal 2025.
So they're actively shrinking the share count.
Consistently. And what this means for you, the investor, is that this consistent reduction of shares outstanding is a powerful driver of per-share value creation. It's management signaling they think the stock is a good investment, and it directly benefits long-term holders.
Dividends, buybacks. But the most important use of capital is probably reinvesting in the business, R&D.
You can definitely argue that. R&D effectiveness is absolutely crucial. Our sources emphasize this is Lam's primary use of capital for reinvestment. In fiscal 2024, they poured $1.9 billion into R&D. That's about 12.7% of their revenue.
It's a significant percentage.
It is. And that investment is deemed critical for maintaining its competitive advantage. You simply can't lead in this industry without relentless innovation.
And how do we know that R&D spending is effective? Is it paying off?
The proof is in the pudding, really. Their sustained market leadership in core areas like etch, their success in winning those key technology inflections like GAA and advanced packaging.
And those best-in-class profit margins we talked about.
Exactly. Those best-in-class profitability metrics are a direct result of having superior, differentiated technology that commands higher prices. It clearly shows their R&D translates into tangible market success and financial performance.
Okay, so looking forward, what are the big engines that will drive Lam's growth?
Well, stepping back to the really big picture, the foundational driver for the entire semiconductor industry is the exponential growth in data.
Wow.
Data generation, data processing, data transmission, it's just exploding.
Data economy?
Precisely. And this massive wave fuels the need for more powerful chips for AI, cloud, 5G, IoT, everything. Since Lam provides the essential tools to make these chips, they are a primary beneficiary of this huge long-term trend. More data means more chips, means more Lam equipment.
Right, the rising tide lifts their boat.
Yeah.
But you mentioned something specific to Lam earlier, complexity.
Yes, that's perhaps the most potent and direct growth driver for Lam, the increasing complexity of semiconductor manufacturing. As chip makers push the limits of physics, making transistors smaller, stacking things higher, the new designs require a greater number of and more sophisticated deposition and etch process steps.
This is that process intensity idea again.
Exactly. More steps, harder steps. And this directly expands Lam's served available market, SAM, per wafer. For every single silicon wafer processed, Lam's tools are needed more times, and the tools themselves need to be more advanced, more capable, and thus more valuable.
Can you give those examples again where this is happening right now?
Sure. We talked about GAA transistors. Getting those nanosheet channels just right is incredibly complex, involving many intricate steps that are highly intensive in ALD and selective etch Lam sweet spots, and also backside power delivery. Moving the power wiring to the back of the chip adds a whole new set of manufacturing steps, again increasing process intensity.
More work for Lam's tools.
Definitely. And then advanced packaging and HBM. The AI boom needs HBM. HBM needs TSVs. And making TSVs relies heavily on Lam's Syndion deep silicon etch and Sabre 3D copper deposition.
So they win from shrinking transistors and from stacking them differently.
That's the beauty of it. Lam benefits from both Moore's law, scaling transistors down, and more than Moore, scaling systems up through packaging. It gives them this powerful, dual-pronged growth trajectory.
Okay, so the technology roadmap itself is a huge growth driver. How does Lam ensure they capture that growth? Through innovation.
Absolutely. It comes down to innovation and their R&D pipeline. That $1.9 billion R&D spend in fiscal 24 isn't just maintenance. It's focused on leading the next wave. Their strategy targets those billion-dollar-plus technology inflections, the big shifts where they can leverage their expertise to gain share. Things like developing even more precise selective etch capabilities or pioneering cryogenic etching for new materials and structures. Constant innovation is key.
And the goal is to translate that innovation into market share gains.
Exactly. The analysis mentions Lam's ambition is to capture over 50% of the incremental SAM created by these new inflections.
Half of the new market opportunity? That's aggressive.
Very. And their broader goal is to reach a high 30% share of the total WFE market. They're aiming to significantly outgrow the market as it evolves towards greater complexity.
And don't forget the service business, the CSBG. That's growing too.
Oh, yes. The CSBG is a significant and compounding growth engine. More machines installed means a bigger base for high-margin, recurring revenue from spares, service, upgrades.
The gift that keeps on giving.
Pretty much. And they're innovating within CSBG too, offering advanced upgrades, sophisticated software tools like Simulator 3D for virtual process optimization, and selling those refurbished Reliant systems for older nodes or specialty chips.
So they're squeezing value out of the entire life cycle.
Exactly. It allows Lam to capture value throughout the entire life cycle of its products and its customers' factories. It makes the business model incredibly sticky and profitable over the long term.
Okay. It sounds like a powerful growth story, driven by technology leadership and strong market trends. But no company is without risks. Let's talk about the challenges. The most obvious one seems to be that cyclicality.
You're right. The analysis is very clear. The most fundamental risk is the inherent cyclicality of the semiconductor industry. It's just unavoidable.
Lam's revenue depends directly on chipmaker spending, which swings wildly.
Exactly. Their CapEx goes up and down based on demand, pricing, inventory. So a prolonged industry downturn could lead to sharp declines in Lam's orders, revenue, and margins.
Even if they manage the cycles well, investors need to expect volatility.
Absolutely. You have to be prepared for significant volatility. It comes with the territory in this sector. A long-term view is essential.
Okay, cyclicality is fundamental. What about that geographic concentration we mentioned earlier, particularly China?
Ah, yes. This is highlighted as potentially the most acute and unpredictable threat Lam faces. The geopolitical risk, specifically the China dilemma.
Acute and unpredictable.
Well, first, the sheer scale of the high revenue concentration. As we said, China was 35% to 42% of revenue recently,
A massive chunk.
which makes Lam highly vulnerable to shifts in U.S.-China relations and trade policy.
You mean export controls, restrictions on selling advanced tech to China.
Precisely. The U.S. government has already implemented controls and could tighten them further. These regulations could directly prohibit Lam from selling certain advanced tools to Chinese customers.
Which could just wipe out a huge portion of their sales.
Potentially, yes. It could erase a substantial portion of its revenue base, almost overnight, depending on the scope of the restrictions. It's a huge overhang.
And is Lam specifically under scrutiny?
Yes, there's active regulatory scrutiny. The analysis mentions Lam is under U.S. government investigation, and there was public criticism from the House Select Committee on the CCP about Lam allegedly failing to comply with requests for documents related to its sales in China.
That doesn't sound good. It suggests more pressure could be coming.
It certainly raises that possibility. So, connecting this for you, the listener, this China dilemma is described as a high-wire act. It creates a kind of binary risk that is difficult to quantify. How do you put a probability on major policy shifts?
Right. And you mentioned a paradox. China demand has actually been strong because of potential sanctions.
Yeah, that's the weird part. Some of that strong China revenue might have been driven by Chinese companies trying to buy equipment before potential new restrictions hit hedging, essentially.
So a tailwind that could suddenly become a headwind.
Exactly, could reverse sharply and suddenly. It makes that huge chunk of revenue feel particularly precarious and unpredictable.
Okay, cyclicality and the massive China geopolitical risk. What other challenges does Lam face? Competition.
Definitely. Competitive threats are always there. They operate in that fiercely competitive oligopoly. Rivals like Applied Materials and Tokyo Electron are big, well-funded, and also investing heavily in R&D.
So Lam can't rest on its laurels.
Not for a second. The analysis warns that a technological misstep, failing to deliver on the next big thing, could lead to rapid market share loss. Continuous, effective R&D isn't optional. It's vital for survival at the top.
Makes sense. And what about that customer concentration again?
Yes, customer concentration risk is another key factor. Relying on a small number of very large customers is inherently risky.
We saw that 17% from one customer.
Right. Losing or even just seeing reduced spending from one or two of those giants would have a material adverse effect on Lam's results.
And it probably gives those big customers a lot of negotiating power too.
It certainly can. They have leverage on pricing and terms, which could pressure Lam's margins over time, even with superior tech.
Okay, one more. Supply chain. These machines must have parts coming from all over.
They do. Supply chain vulnerabilities are a real concern. Lam manages an incredibly complex global supply chain spanning more than 24 countries.
So lots of potential points of failure.
Exactly. It's vulnerable to all sorts of disruptions. Geopolitical events, natural disasters, public health crises, or component shortages.
Like we saw during the pandemic.
Precisely. Any major disruption could stop them from building and delivering machines, leading to lost revenue, higher costs, and unhappy customers. It's a constant operational juggling act.
All right, we've covered the strengths, the growth drivers, the technology, and the significant risks. How does all this translate into valuation? How do you even begin to value a company like Lam?
That's the million-dollar question, isn't it? Our sources stress it requires a really nuanced approach. You have to balance those premium financial characteristics, the high margins, strong ROIC, cash flow.
Against the deep cyclicality and those big geopolitical risks, especially China.
Exactly. It's a real trade-off. So let's look at some relative valuation metrics. The standard price-to-earnings PE ratio was around 26.3x based on mid-2025 numbers.
26.3x, is that high?
Low.
Average.
Well, for cyclical companies like Lam, the PE can be tricky. Often, the PE looks highest when earnings are depressed at the bottom of the cycle because the market anticipates a recovery.
And it looks lowest at the peak when earnings are maxed out because the market expects a downturn.
Exactly. So you can't just look at the current PE in isolation. You really need to assess it relative to Lam's normalized mid-cycle earnings power, what they might earn on average over a full cycle.
Okay, so context is key for PE. What about other multiples?
Other metrics like EV to sales around 8.1x and price to book around 14.4x are described as elevated.
Elevated, meaning the market is already recognizing Lam's quality.
Yes, it suggests the market appreciates the high margins, the technological leadership, the capital-efficient model. It's willing to pay up for that quality.
And how does Lam's valuation compare to its main competitors, like Applied Materials or KLA?
Good question. The peer comparison in our analysis shows Lam typically boasts superior profitability metrics, like higher operating margins and ROE compared to peers.
Which could justify a higher valuation multiple for Lam.
It definitely argues for a premium valuation, yes. Better profitability often commands a higher price tag. However, the analysis also adds a crucial caveat. Lam's higher exposure to the volatile memory market, and most importantly to China, may warrant a discount relative to the more diversified profile of a competitor like Applied Materials.
So better profits might argue for a premium, but higher specific risks might argue for a discount. A real tug of war.
Exactly. It's not clear-cut.
So trying to pull this together for a fair value consideration, what's the bottom line?
Well, connecting it all, Lam's best-in-class profitability, dominant market position, and direct leverage to powerful secular growth trends like AI and 3D scaling all strongly argue for a premium valuation. They're a leader in enabling the future. But that premium absolutely must be tempered by a significant discount. You have to account for that high earnings volatility from the cycles and, critically, that acute and difficult-to-predict geopolitical risk tied to China.
The China risk looms large in any valuation discussion.
It really has to. So what does this mean for you? Your own assessment of Lam's fair value really hinges on two big things. First, your outlook for the semiconductor cycle. Are we heading into a strong upswing, a plateau, another dip? And second, maybe even more importantly, your tolerance for geopolitical uncertainty. How much risk are you willing to take on related to those U.S.-China tensions?
It's a complex judgment call, not just a simple calculation.
Absolutely. There's no single right answer here. It depends heavily on individual outlook and risk appetite. #Tax7, leadership and governance.
Okay, let's touch briefly on the people guiding the ship through all of this complexity. What's the take on Lam's management and corporate governance?
Yeah, it's important. The company is led by President and CEO Tim Archer, and the management team is seen as having a clear strategic vision, particularly focused on capitalizing on those big technology inflections we discussed. Our sources point to a solid track record of navigating the complexities of the semiconductor cycle, managing through downturns while investing for the future.
And we already talked about their capital allocation being shareholder friendly.
Right. That prudent and shareholder-friendly capital allocation balancing R&D with dividends and buybacks is seen as a strength of this leadership team.
Okay, and what about the oversight? The board, the governance structure?
The corporate governance structure appears pretty robust and aligned with shareholder interests. Key points include an independent chairman of the board and a majority of independent directors overall.
So good oversight of management.
That's the goal. The board has diverse backgrounds relevant to Lam's business tech, finance, global operations policy, and they have a proactive stockholder engagement program to listen to investors.
Sounds like standard best practices. What about how executives get paid? Does it align incentives?
That's always a key question. Executive compensation at Lam is described as heavily weighted towards performance-based incentives.
Meaning less fixed salary, more pay tied to hitting targets.
Exactly. There's an annual incentive program, AIP, mostly cash, tied to hitting annual goals, with a big focus on non-GAAP operating profit as a percentage of revenue.
So incentivizing profitable growth.
And the bigger piece is the long-term incentive program, LTIP, mostly equity, like stock units and options. Critically, a significant portion involves market-based PRSU's performance-restricted stock units, where vesting depends on Lam's total shareholder return relative to its peers over a multi-year period.
So they only get fully paid out if Lam's stock outperforms its competitors.
Correct. This structure is designed to directly incentivize executives to deliver profitable growth and stock price outperformance, aligning their interests very closely with long-term shareholders.
It seems like a sensible structure. Lastly, how's their communication with investors? Guidance, transparency.
On guidance and communication, management seems to have built a track record of credible and transparent communication. Our sources note that their financial results and their forward-looking guidance have consistently met or exceeded analyst expectations recently.
Suggesting they guide realistically, perhaps even a bit conservatively.
It could suggest that, yeah. Which helps build trust. They're active on earnings calls, at conferences, keeping the market informed. Overall, leadership and governance seem like areas of strength. #outro.
All right, so we've covered a lot of ground here in our deep dive on Lam Research. What's the final takeaway for you, our listener?
We're talking about a company that is truly fundamental to our digital world. They are quite literally sculpting the future of technology at the atomic level.
Enabling almost every advanced chip that gets made. Indispensable, really.
Absolutely. And yet, a huge, significant part of their destiny seems tied up in this high-stakes geopolitical chess game, especially regarding China.
That tension is undeniable.
So considering that nearly every advanced chip is built with Lam technology, here's a thought to leave you with. How much does that China dilemma, those restrictions and potential future restrictions, truly act as a brake on the pace of global innovation?
Interesting question. And what are the ripple effects? Not just for Lam, but for everything that relies on cutting-edge chips, from the next generation of AI to the features and even the cost of your next smartphone.
Yeah, the implications are potentially vast and interconnected.
Something to ponder. That's all for this deep dive.
Thanks for tuning in.